Okay.
Well, the fact is when you're trading options, it's quite doable. If you, let's say you're risking 5% of your account in an options position, and that options position gains 100%, which is not an uncommon return trading 60 delta calls, you're done. You've made your 5% per month.
This is the Money Seed Podcast, where we discuss all things investing, plain and simple, the way it should be. Please remember, this show is for educational and entertainment purposes only and is not intended to be investment advice. Welcome back to the Money Seed Podcast. I am really excited about this interview. I myself absolutely love options and options trading and have for about 3 years. I got into options during the COVID crash when we were all home, and I have been absolutely taken by options ever since. So today I have an expert in the field with me, Simon Rhee. Simon runs the Tao of Trading, where he teaches individuals how to trade online. Simon, welcome to the show.
Hi, Gabe. Thanks very much for having me.
Simon, tell us more about Tao of Trading. What is it, and who is it aimed for? Who is it designed for?
So, it must be 4 years ago now. I wrote a book on options trading called the Tao of Trading. And the first question you might have is, why does the world need yet another book on options trading? Hundreds of them have been written. Why do we need another one? I've worked in finance for 3 decades. I've read quite a few of those options trading books that are available, and really almost to a book, and it's certainly in my experience that they're both difficult and boring. They're the sorts of book you'd only finish if you had a boss that was making you read it, either that or unless you're just exceptionally keen. And so what I thought the world needed was a book on options trading that was both engaging and easy. And based on the feedback that I've got from my book, I think I've ticked those 2 boxes. Many people have written to me and said that they've devoured my book within a weekend. And it's 342 pages. It's not a booklet, but it's written, I believe, in a very accessible style. I've tried to avoid the use of math or complex jargon as much as possible, and really bring options into plain English, and try and demystify the whole process of trading them and what they're all about.
Simon, for those listeners who may not be familiar with what an option is, what is a really simple, straightforward definition of what an option is?
Sure. So there are 2 types of options, and only 2 kinds. You've got call options and put options, and we buy call options when we expect the price of the underlying stock to go up. Just think call up, as in call up a friend. And we buy put options when we think the price of the underlying stock is going to go down. You just think put down, as in put down your luggage. And so what we're doing is basically building strategies to take advantage of both rising stock prices and falling stock prices. Now, when you buy an option, you never actually buy the underlying stock. What you're doing if you buy a call option, remember call up, we want the stock price to go up, you're effectively renting a stock. In my book, I describe call options as they're like the Airbnb of the finance industry, because you get to have most of the benefits of owning the underlying stock for a finite period of time, but you don't have the enormous upfront cost associated with it. So if you want to rent a property in Malibu for 2 weeks, it's going to cost you much, much less than buying that property. But for that 2-week period or that 4-week period, you get the benefits of having that property, of having possession of it. And that's really what a call option gives you. If the stock price moves up, you can make money on that stock price, but you can do it for a few $100s rather than several thousands of dollars. And so the beauty of options is they give you leverage. Leverage just means large potential gains on a small capital outlay. And so options are great for people who want to start small, or for people who only have a small amount of risk capital.
And Simon, if somebody is already trading stocks, right? Mm-hmm. Let's say they're a retail investor, they've had their stock brokerage account open for a few years, and they have their stocks and ETFs in there, and sometimes they buy something because they want to invest in the company and they have this stock and that stock. what additional benefits would they gain from also investing in options? What does options give them that stocks don't?
Well, options gives you asymmetric payoff. All right. That's just a technical way of saying a payoff that is uneven. All right. Asymmetric just means not symmetrical. And when we talk about options, what we're talking about is capped downside with uncapped upside. So when you buy a stock, if the stock falls 10% and you put $10,000 into it, you might lose $1,000. All right. If you've paid $200 in option premium and the same stock falls 10%, the most you can lose is that $200. So they're really, really handy from a risk management perspective. But if the stock rises, the amount of money you could make on that $200 option purchase could end up being actually quite similar to the amount of money you could make on your $10,000 stock purchase. So that's where you get leverage, plus you get uncapped upside with capped downside. Now, there are other tools in finance such as futures and Forex, foreign exchange, which also offer leverage. But in futures and Forex, the leverage works for you and against you. With options, it depending on how you structure the option, it only works for you. You can always limit your downside.
And Simon, when I first discovered options, roughly 3 years ago, when we were all at home during COVID and we had all kinds of time in front of the computer, I instantly fell in love with it. I have an engineering background. I've always been comfortable with numbers and math, and I was just instantly drawn to the mathematical side of it. Maybe a little bit more. What is your underlying strategy, and what strategies do you use?
So I'm a trend follower at heart. Trend following has got 200 years of research and evidence backing it up. It is by far the most researched academically form of or style of trading, and it's sort of been proven time and again. And the way I do it, the way I approach it, the way I teach it, it's very visual. It can become quite intuitive to the point where our members can look at a chart and know within a split second whether it's something they should be buying or selling or just avoiding altogether. So I think that's really important. It makes trading more enjoyable when you can start to build that intuition. And having a framework, having setups, using indicators is really important because markets are almost designed such that your human intuition will fail you. If you watch somebody throw a ball and you watch the arc of that ball fly through the air, you've got a really good inbuilt intuition of the path that ball is likely to take as it falls towards the ground. If you look at a stock price chart, I'm not picking on you, I mean any human has actually got really poor intuition as to what is likely to happen in the future. And market cycles are designed to manipulate our emotions and getting us to do the wrong things at the wrong time. So yeah, I've got a bunch of trading rules. I really only use 4 different setups. 3 of them are trend following in nature, and I do use a counter trend setup as well, which has been really handy sort of since the middle of last year, where markets have been a lot more choppy and volatile.
And Simon, when somebody joins your program, right, and they start learning to trade with you using your methodologies, how long typically does it take for them to get the hang of it, to feel comfortable, and to effectively manage risk well? How long does it take to get the hang of things?
Obviously, every individual is different. I mean, I've had people go through our program within a weekend. They are the exception, but a few people have done that. I'd say most people would spend a few weeks, 4 to 6 weeks, going through the learning materials. And then what I usually say to people is your first 100 trades, that's like your apprenticeship, right? And by the time you've done 100 trades, you're familiar with the system. You've made a couple of mistakes. You've probably fumbled the ball a couple of times along the way. But by the end of that 100 trades, you should be reasonably competent and reasonably confident. And that's when you can start putting money to work and having some expectation of return. I usually say to people within that first 100 trades, all you're trying to do is not lose money. You're not trying to make any money at all. But if you can come out of that first 100 trades and your account size hasn't fallen, success is really just a matter of time at that point. And so long as you follow the risk management guidelines that we teach and drill into you, it would be virtually impossible for you to blow up your account. And like I said, so long as you can learn how to not lose money, making money through time becomes almost inevitable.
I like that way to look at it. Your first 100 trades is really just your apprenticeship and you're trying not to lose money. I think that's a great way to look at it because it sets the correct expectation, right? This is not simple. I don't think anyone should expect to start winning trades at a high frequency just out of the gate. It does take a while to get used to it. And getting back to the psychology of it, I recently read a great book. It was called The Biggest Loser Wins. I'm not sure if you are familiar with it, but
I don't know that one.
Yeah, no, it's a great book, and it was written by a professional trader, somebody who trades stocks and ETFs full time, and they've won several different trading competitions. And they started looking at a lot of the stats in the book of brokerages who have available information on what percentage of their clients make money or lose money. And throughout the industry, it's something like 90% of retail investors lose money. And the main reason is not because they picked the wrong stocks or whatever. It's just because psychologically and mentally, it's exactly what you're saying is our intuition works against us and we let our emotions get in the way, and people let panic take over, and it does take some time to master the inner game, the mind game of everything. But it sounds like that's part of your course, and that sounds like where you start the course almost.
I think that mastering that inner game, trading psychology, mindset, that to me, that's the final frontier in trading that sets apart the aspiring wannabes from the people who do this for a living and are consistently profitable. Now, I wouldn't say we start there. We start with more basic things like technical analysis. What is a chart? What indicators do we use? What is an option? How are options used? What is volatility? What is the VIX telling us? Module 6, we've got 7 modules. Module 6 is trading psychology and mindset. And I think it's really helpful for people to have been through learning what options are, what the setups we teach are before getting to that. Because then it kind of all falls into place. And many of our members say that actually the module on trading psychology and mindset ends up being their favorite module. Because it doesn't just help you in trading, it helps you in real life as well.
And yeah, it took me, like I said, it took me the better part of, I would say, 1.5 to 2 years to really get the hang of it. It does take time. For me, it probably took 100 trades, maybe more. But I'm definitely doing much better now. I have a much better understanding of sort of the sizing, like how much buying power I'm using up in each position, and how much buying power I always need to have available in case the market goes against me, etc. So it does take a while to get the hang of it. Tell me, what are some of the biggest mistakes people make?
Yeah, wanting to be right, I think is probably the biggest mistake. Things in trading, you can be right 60% of the time, and you can be a phenomenally profitable trader. If you're managing your risk and you're managing your risk reward, 60% win ratio is fantastic. But in everyday life, being right only 60% of the time, it probably kind of sucks. If you're right only 60% of the time in your job, you're probably going to get the sack. Your boss is going to have a stern word with you. This is one of the many ways where the trading world does not emulate real life. And so the problem happens when somebody enters a trade and it moves against them, but they don't acknowledge that they're wrong, or either that they're wrong or that they've made a mistake, and that they dig their heels in and say, no, I'm right, the market's wrong. I'm going to hold this position and I will be proven right eventually. And what happens is the hole just gets deeper and deeper, and they don't just do this on one position, they do this across their whole portfolio. And invariably, that is how accounts get blown up. As a trader, it's your job to recognize when you're wrong early and quickly, and to prevent small losses from becoming big losses. So it is fine to be wrong in trading, all right? It is not fine to not change your view in light of changing circumstances, all right? The thing is, in trading, we're always playing with probabilities, all right? We're looking for a probabilistic edge. All a probabilistic edge means is that one outcome is more likely than other outcomes. But we're talking about likelihood, probability, not certainty. There's a reason this job is called trading and not guaranteed profits. And what people need to understand is that it takes a number of trials for probability to work its magic. So if you're trying to judge your trading performance on one trade or 5 trades, you're being very, very short-sighted. All right, because even with a 60% win rate, you can absolutely have 4 or 5 losing trades in a row. That's well within the realms of probability, and that is why risk management is so important. And like I said, stopping small losses from becoming big losses, because it's big losses that will wipe out your account. If you get really good at acknowledging when you're wrong, taking the ego out of the equation, and just be happy to take little paper cuts, you can always live to fight another day.
And Simon, getting back to that, where you can have 4, 5, 6 losses in a row, because I agree with you, it's well within the realms of possibility. What kind of an account size do you think people should start with, right? The idea is, if I start with a very small account, let's say $5,000, some of those options are expensive. If I want to buy an option in a stock or an ETF that is trading around $100 a share, an option can easily cost $500 or $1,000. And so I can only be wrong. If I'm wrong 5 times in a row, my account's blown up. So what kind of an account size do you think people should start with?
Well, I think $5,000 is a realistic minimum. And if you're looking to trade stocks with a high stock price, you're looking to trade NVIDIA, for example, you've got to learn how to trade spreads. All right, because trading a spread makes it much, much cheaper, and it actually helps you manage your risk. All right, so we do offer a module called the Ultimate Guide to Debit Spreads, which is perfect for small accounts. Look, I have had members start with numbers smaller than 5,000, but you're right. If you're starting with much less than that, it doesn't give you the flexibility to make a couple of mistakes up front. Whereas if you've got a $5,000 account and you're only risking a maximum of $500 per trade, you can still make a couple of mistakes. The other point I should make out is that we do train people to be proactive in their risk management. So just because you've spent $500 in option premium, it doesn't mean that you're happy to lose $500. In fact, I've got what I call my OMG stop loss level is if your premium declines in value by 50%. So if you spend $500 in premium and that value drops to 250, you cut that position no matter what. Doesn't matter if you think it's going to turn around the next day, you just get out. That sort of capital preservation mentality is so important. But very often we're trying to get out of positions well before a 50% loss on a single position. So, on a $500 position, ideally we're getting out, when the loss is only $100, $150.
That's actually a really good way to do it, so that you have built-in mechanisms to limit your losses, right? So even if, for example, you potentially could lose $300, $400, $500 on a call option going to zero, you're going to cut that short. You're not going to hold it to expiration.
Yeah. I always say to people, I need 3 or 4 good reasons to get into a trade. I only need 1 reason to get out. And that 1 reason could be, it doesn't feel right. Honestly, if something doesn't look or doesn't feel or doesn't smell right to me, I would rather walk away with a small loss than come back to my screens the next day thinking, should have got out, because you can always get back in, and transaction charges these days, they're either zero or they're virtually zero. If you change your mind the next day, you can always get back in. You've got to retain that mental flexibility to be able to do so.
It is quite easy to be hands-off in a stock trading account, right? I can buy a stock and check on it once a month or twice a year. Options are very hands-on. How many minutes or hours do your typical students trade per day?
Well, one of my core principles of trading is I do not want to be stuck in front of a screen all day. I want to hang out with my kids. I want to enjoy life. I want to get on with life. Trading is a means to an end. So we teach people how to scan for trades, which will give you a short list of potential candidates within 2 seconds. And then it's just a case of really scanning the scan results for stocks that look like they have high potential. I would say after you've done your 100 trades, you're looking at an average of 20 to 30 minutes a day. Now, there will be days where maybe you're spending an hour, There'll be other days where it takes you 2 minutes, where it really is just a maintenance check. But I would say on average 20 to 30 minutes a day.
And in that time, when you say 20 to 30 minutes, how glued are you to the screen? I mean, is it something where you're just checking every 5 minutes to see if a certain indicator is doing what you're expecting it to do, or you're really actively buying, selling, buying, selling?
No, I see. I don't day trade. I make all of my decisions based off daily charts. I make all of my trading decisions when the market is closed. All right. So I'm not distracted by green lights and red lights and, prices moving, which can all trigger the emotions, right?
Right.
So I make all the decisions when the market is closed. And then when the market opens, I'll watch it for 10 or 15 minutes. Then I'll start placing my trades. I live in Singapore, right? So I place my trades and then I go to bed. And then I wake up the next morning and see how they went. So I'm not checking the trades. I'm not fiddling with them. I'm really very disciplined about my setups, my execution, and then just letting the market do whatever the market will do and not fiddling.
And Simon, at this point, I want to get a little bit more technical in because I'm really interested to learn more about your strategy. So you mentioned just a few minutes ago that you don't day trade. So tell me, when you buy a typical option, how many days to expiration are you looking at?
So look, it's probably gotten a little bit shorter since last year, but I would say typically, on average, 30 days out.
30 days,
to 40, 30 to 45 days. And I find I'm typically holding a position these days anywhere from 2 to 3 days to 2 to 3 weeks.
Nice. Got it. So you hold it for 2 to 3 days, 2 to 3 weeks. And what deltas do you go to when you buy it?
So if I'm buying just a plain vanilla call or put, I'm usually buying slightly in the money, delta 60 to delta 70.
So, I mean, if there is that correlation, right? A lot of people say there's a correlation between the deltas and the rough mathematical probability of that being, in the money. So if you're in the 60, 70 delta range and buying a call option, then on average, you're going to be 60 to 70% in the money, right? Like that's the kind of success rate you're aiming for.
That's sort of the long-term probabilities. Yeah.
So you're correct 60 to 70% of the time, and you already alluded to how you manage risk, right? So if the trade moves against you, then you try to get out.
I get out no matter what, but usually I'll get out before that happens. At the first signs of danger, the first signs of something unexpected happening, I'll get out. Because like I said, you can always get back in the next day or the day after if things do start moving in the direction you originally thought.
And do you go both ways, Simon? Do you buy puts and calls depending on which way a particular? Yeah,
absolutely. Yeah, I think trading both sides of the market is going to be a really important skill to have for the next several years. I think that we're in an environment of high economic volatility. We've got inflation peaked and came back, and now it looks like inflation's reaccelerating. And if you look at the last inflationary period we had during the 70s, it was a volatile period economically, and economic volatility translates into financial market volatility. I think we could be looking at several years of wide-ranging chop.
And Simon, what tickers do you trade most often?
Well, I'm open-minded to trading anything if the numbers stack up, but really, it tends to be large cap to mega cap, blue chip, household name type stocks. I only trade the US market, and I would say, 80% of the stocks I trade you would have heard of, and most of your listeners would have heard of.
And do you basically trade only stocks, or do you get into ETFs, or do you trade like commodity indices or anything like that?
Yeah, all of the above. There's always a trend to be found somewhere, all right? And if the stock market is looking particularly choppy and trendless, that's when you can look at commodity ETFs, index ETFs. You can look at, even foreign exchange ETFs. So there's always a trend to be found somewhere. And of course, with trading options, we're looking for downtrends as well as uptrends.
And Simon, do you actively hedge in your portfolio?
I do. It depends on the circumstances. We do have a module on hedging called How to Hedge. But yeah, hedging is certainly something that I will do. Hedging is I think it's more relevant in a bull market where you've got a market that is just kind of grinding higher and higher and higher, and you get to points where the market gets a little bit overextended to the upside, and that's when you'll put some hedges on just to protect your portfolio in case you do get a reversion to the mean. Bear markets tend to be more about two-way action, aggressive rallies and big sell-offs. I find hedging tends to be less of a feature in this sort of a market, and really just trading both sides of the market becomes more of a feature.
And Simon, if I may ask, what are your favorite indicators you use to establish a trend?
I mean, I like moving averages because they're simple. They provide very simple but very powerful visual clues. They've been tested by academics to have statistical significance. So I mean, moving averages is kind of like the first go-to for me in terms of determining trend. It's a trend direction. I'll look at DMI and ADX to determine momentum. So trend tells you what direction we're moving in. Momentum tells you how much longer are we likely to keep moving in that direction. And then I'll use things like a stochastic oscillator just to see where a stock is within its cycle of movement.
Simon, so if you really are only in a trade for, let's say, from 2 or 3 days to 2 or 3 weeks, right, then do you need to establish any long-term views on the market? Because it doesn't sound like you're holding these positions for a long time. So in reality, you're probably making money whether the market goes up or down or sideways. Is that a fair statement?
Yeah, that's fair. I think it's useful to have a view of the market that is commensurate with the views that you're taking in your trading. So, if I've got a view that the S&P is bullish over the next month, I want to be looking primarily for long trades. I don't mind having 1 or 2 short trades opportunistically, but primarily I want to be trading in sympathy with the trend of the overall market, because if the market's trending up, generally 70% of stocks are going to be moving up with it. And the opposite is also true.
And Simon, I know that for people who trade stocks, right, most of them, like most of your capital will be deployed. But in options, a lot of people like to hold back a little bit of cash or to always have buying power. How much of your capital is invested at any time?
So never more than 50%. And the fact is with options, you never, ever need to go all in because of the leverage they offer. And in fact, going all in is generally a really bad idea. So I cap my risk exposure to 50% of my NLV, my net liquidating value. And in a market like we're seeing right now, where it's pretty choppy and it's trading within a fairly fine band, I'm probably 80% cash at the moment.
Amazing. Wow. Okay. And Simon, maybe tell us a little bit more about the success your students are having. So if somebody signs up, they go through your course, they start trading with you, they go through their first 100 trades, and their apprenticeship is finished. What kind of a return are your students getting?
Well, look, our most successful student made 717% in 2021. This is an example of where the student becomes the master. I can tell you he outperformed me that year. But what I say to our students is, once you've done your first 100 trades, 5% per month is a realistic sort of stretch target.
Wow. Whoa, Simon. Okay, so slow down. Let's say that again. Not per year, per month. 5% per month.
Per month.
Wow. Okay.
Well, the fact is, when you're trading options, it's quite doable. If you, let's say you're risking 5% of your account in an options position, and that options position gains 100%, which is not an uncommon return, trading 60 delta calls, you're done. You've made your 5% per month. And what I encourage members to do, if they hit that target, certainly in the first few months, just stop trading, book the profits, go on holiday, paper trade, whatever, but just keep that money in the bank and then come back to it the following month, and just get used to making those kinds of returns. Don't try and get greedy. If you're risking 5% of your NLV on a trade and it makes 50%, your NLV, your portfolio is up 2.5%. You find 2 trades like that a month, you're done. You've made your return objective. Now, obviously, there's going to be losing trades along the way as well. But hopefully, if you're making 50%, you're only losing 25% on your losers, or if you're making 100%, you're only losing 50% on your losers. And this is how you can build wealth at an accelerated rate, by compounding returns regularly. Because if you can compound at 5% a month, in 5 years' time, those returns can really become life-changing. And what we find is, you're right, most people don't come to options trading as like their first dabble. Usually they've been trading stocks for a while, and they're looking for something different. But you look at the long-term annual return of the S&P 500, it's about 10% per annum. Now, 10% per annum it's not a bad return. Okay, it's certainly better than what we've been getting on cash for the last 40 years. But if you want life-changing returns at 10% per annum, you've got to be young.
Mm-hmm.
You've got to have that 30 to 40 year runway for the compounding effect to work its magic. If you're in your 40s and you don't have enough money to retire on, you don't really have enough time if you're only earning 10% per annum. And the pushback we commonly get is, well, if you can't expect to earn more than 10% per annum without taking too much risk. This is just an old Wall Street myth. Wall Street doesn't want you managing your own money and potentially embarrassing the returns that they would ever get for you, because they want to charge you a fee for earning you that 10% per annum. But the difference is, options trading, as you said before, it is hands-on, it requires education, and it requires consistent effort. It's not to say it requires a lot of effort, but it requires you to show up every day. All right. And consistency is a superpower in life, and certainly absolutely in trading as well.
Yeah, I think you said a lot of things, Simon, there, but let me just start by agreeing with one of the last things you mentioned with consistency is, yeah, it took me about like 3 years to get the hang of options. I do a different system than you use. I follow the taste of trade method. And yeah, I mean, I check on it every day. I usually place 1 or 2 trades a week. I adjust my trades, once or twice a week, depending. And I think this year I'm finally at the point where like I'm consistent and it's going well. But I mean, my returns are nowhere near as good as the numbers you mentioned. Right now I'm getting about like my personal goal is 15% a year. And I think this year is probably going to be the first year where I meet and exceed that. And it's not because I got lucky on 1 or 2 big moves. It's because it's a completely different ways to structure the trades, where the term they use is picking up pennies in front of the steamroller, right? Is that where I'm selling premium, and then I close it early, and I slowly do it. And one of the things I like about options is, once you get the hang of it, you can structure your options trades to have as little risk or as much risk as you want. Like, you getting back to spreads. For example, I can sell a deep out of the money credit spread where I have like an 80% or 85% chance of winning. And if I want to go really crazy, I can go and sell a put in the 90 or 95 delta even, where really I'm going to win on that 19 times out of 20. And I just have to be really careful on how to manage that 1 out of 20 when it really moves against me. And I make mistakes. I learn from those mistakes, and I'm finally getting better. One of the mistakes that I made last year, which really hurt me, was I got involved in earnings trades on some of the meme stocks, right? Like, I got involved in some stocks, like some companies that just were not big companies, right? Like I got stuck on the wrong end of an earnings trade in Peloton, on the wrong side of an earnings trade in Snap. And come to think of it, was that last year? Was it? No, that was a year and a half. It was like late in 2021. That's right.
Right.
Late in 2021, when the meme stocks kind of cratered. And I had
the wheels started falling off. Those sorts of names.
Yeah, and those earnings trades, they had like one delta moves. Like Peloton went from $80 a share. Earnings came out, and they went down to like 45, and I had a naked put. I had a J Lizard, right? So my losses were capped on the upside, and it was uncapped on the downside. And all of a sudden, my $120 of credit premium turned into like a $4,000 loss. But I mean, these are mistakes I learned, right? So I don't do small cap stocks anymore. I stick mainly to just ETFs and large caps. But I mean, it's a process. It does take consistency. It does take time. And so I'm always amazed by people who have found consistent success in options, because It's not easy. It takes time, but once you get the hang of it, it is truly rewarding. So
it is, but it's like anything in life. I mean, how many people have the the body that they really want, right? Not many of us, right? And the only thing that's eluding most people is consistency. Consistent diet, consistent exercise. It's boring and it takes effort, but the rewards are there if you apply consistency. I mean, there are so many analogies, but yeah, I think that consistency is really important in trading. And the other thing you said, I think was really important was, you're not looking to kind of earn your annual income on one or two trades. It's all about just booking incremental gains. Hitting base hits, hitting singles. Yeah, it's nice when the big ones come along every now and then, but you're not hoping for them or actively targeting them.
Yeah, thanks for bringing that up. I remember there were some crazy stories that I heard during the pandemic, where in the Robinhood, right, the Robinhood community, where some people, like, they heard from their cousin's best friend that he should buy like call options in Tesla, and so there was this one guy who sold his pickup truck and bought $40,000 worth of Tesla calls. And it's like, I mean, like, what do you even say to that? I mean, no, it's just that's not the way you want to approach any kind of investment. But yeah, no, I agree with you. That just be reasonable, understand the risk, and it takes time. But thanks to people like you, I mean, there's an easy way to learn, right? I mean, it took me about 3 years to get the hang of it, and a lot of it was just trial and error. And I think if I would have gotten a coach from day one, I probably it probably would have paid for itself, right? So
yeah, well, there's three ways to learn. There's the quick way, the slow way, and the traumatic way. The quick way is you learn from somebody who's already done it. The slow way is you figure it out yourself and make your own mistakes and learn from them. And the tragic way is you don't even learn from your own mistakes. And sadly, that is the path many traders take, because the lessons are not obvious. You've really got to be clued into what you're doing and what's happening for those lessons to reveal themselves.
Simon, about your courses, tell us a little bit more. How long does it take to complete the program, and how much does it cost?
So we offer 3 tiers of membership. So we've got a 1-year program called Options Academy On Demand. And that retails for $797. And it would take somebody, look, there's about 25 hours worth of content in there now. So it probably takes somebody a few weeks, I would say, on average. Then we've got Options Academy Elevate, which is a lifetime program that also includes modules on how to hedge and how to trade debit spreads and how to trade diagonal spreads. That also includes 12 monthly coaching calls to just keep you on track and keep you engaged. That one costs $2,500. And then there's Options Academy Accelerate, which is, this is like the graduate school. If you've been through one of the other 2 programs, this is where you get to hear from me every day. I send our members a daily video analyzing the markets, analyzing the technicals, the macro situation, and I also share with people what trades I'm taking, how I'm managing them, where I'm getting out at a profit, where I'm cutting losses, and that includes a bi-weekly webinar as well.
And Simon, your book, right, which is Tao of Trading, How to Build Wealth in Any Market. Tell us a little bit more about what people can learn from the book, and how is that different from the courses?
So the book, the courses sort of build on from the book. So the book is like the foundation. The book, I will give you one of the trading methods that we use in the courses, which is one of my go-to trend following methods. And the book will share with you risk management. There's an important chapter there on psychology and mindset. We talk about spreads in the book. We talk about how to make it all happen. So, I mean, if you are very proactive and very dedicated, honestly, the book contains everything that you need. You don't honestly need anything extra than that. But I think most people, well, a lot of people find that they've read the book, but the courses just kind of bring it all together. They get to hear my voice. They get to see my screens. They get to use the scans that we develop. And it just accelerates their progress.
And Simon, maybe as we move toward closing out, Do you have any particular outlooks on the market? I think earlier in this interview, you mentioned that you think the market's going to be choppy for the next few years. What can people expect?
Look, I think we can expect a period where it's going to feel like 2022 again. The market just has periods where it just seems to fall every day. And that will be followed by periods where hope soar and, it looks like the market's going to make new highs. And ultimately, I think we're likely to be trapped in a very wide range that will ultimately destroy the hopes of bulls and bears by the end of it. And knowing how to trade both sides of the market, like I said, I think is going to be a really valuable skill.
Simon, where can people reach out to you and where can they learn more about Tao of Trading?
So you can follow me on Twitter. My handle is Simon_Ree, R-E-E. My book, The Tao of Trading, is available on Amazon. And my website is taofoftrading.com. That's TAOOFTRADING.com. And Gabe, what I've done is I've got a bit of a special offer for your audience. If they go to taofoftrading.com/Gabor, Gabor, they'll be able to download the first chapter of my book for free and also get some discounts on our programs.
That's excellent. Simon, thank you very much for doing that. I will put that into the show notes and in the video description on YouTube. Simon Ree from the Tao of Trading, thank you very much for this interview. I could talk all day about options. I really do like options. And if anyone feels a little bit bored just trading stocks and they want some more action, I know it's probably the wrong thing to say, but I love options. Options takes trading to a completely different level, and it allows and gives control that you just don't get with normal stocks. So I strongly recommend it. Get into it, and yeah, who knows where it leads. Simon, thank you very much.
Thanks, Gabe.
If you enjoyed this episode with Simon Ree, don't forget to check out his YouTube channel called the Tao of Trading, where Simon talks about his options trades, his option setups, and how he earns incredible returns year after year. Thanks very much.